Hello, class, and welcome to our third lecture series on financial accounting or principles of accounting. And I'm your instructor, Jamal Haider. So let's start. Today, we are starting chapter 2, which is transaction analysis. And our first learning objective is explain what a transaction is. So a transaction, when we talk about transactions, remember this transaction, we're talking about the accounting transaction. And normally you can also have it, but there are different kinds of transaction. But in accounting, we consider transaction that any event that has financial impact on the business. Right, guys? Financial impact. So similarly, like resources stuff that we defined in our, I think if you have studied with me the economics, so in first lecture we defined resources that anything that have monetary value. So similarly, any event that affect the transaction in monetary terms or it has financial impact. So all the sunshine that the company is receiving, the daylight stuff, it's free of cost, don't have any financial impact. So that's why these are not transaction. So if you are using this electricity to shine your office rooms, so it has financial impact. Yes, you need to buy bulb, electricity, pay for the bills, it's like that. So it's a financial impact. Plus the sale, this kind of stuff, when you sell your goods, there is a transaction, right? So remember, the other definition is that it can be measured reliably, right? It's not like that you sold the goods to the customers and one piece is, for example, $10. $10, right? But when you sell it to your friend or something, you sell it for $2. No, that's not reliability, right? There should be just some justice or some reliability to that one. And remember, transaction provide information regarding something is given and something is received. So when you sell the goods, you have given up the goods, you receive money, right? So at least the transaction, what we're talking about, the accounting transaction, it records both sides. So the party who is receiving something, we also record that. The party who is given something, we also record that. So we have given the goods, we recorded, okay, goods has been decreased from our inventory, from our stock, from our finished goods account, right? And then we raise the money, okay, the cash has increased by a customer, or so transaction is complete, right? So transaction is that has financial impact. And what are the consequences of these transactions? It records both sides. And remember, transaction means only that qualify with the definition of a transaction which has financial impact on the business. Here we go. For example, a company is Whole Food Market Incorporation. So transaction is, So transaction is you purchase fresh from producers, right? What would be the transaction? Two sides. When you purchase some fresh foods to sell, what would be the giving side and what would be the receiving side? So you receive goods are coming into the business and money is going out of the business. So two sides are that inventory is coming inside, right? And money is going out. So that is the two sides. When you sell the product, now product is going out, money is coming in. Two sides. Borrowing the money, right? How do you deal with that one? How you are going to record this one? And what are the two sides? Borrow money Money is coming inside. What about the other party or other side? You increase your liability, right? So recall your discussion regarding the liability. Liability means outsiders claim, right? So equation is assets is equal to liabilities plus owner's equity. Sorry about my bad. Wait a second. So I think I should write in my next slide. So that would be very easy for that. So when you borrow money, money is coming inside the business, right? Your cash, cash account goes up. And on the other hand, the other side of the transaction is liability has also increased. Repaying the loan. When you repay the loan, what will happen? Cash is going down, going out from the business, and your liability, your creditors, their claim is also going down, right? So it means at least transaction has two sides. Number one, the given side. Number two is the receive side. Right, guys? Okay, our second learning objective is number one, define account and list and differentiate between different types of account. So let's talk about this. Okay, here we go. So we know that the accounting equation is assets is equal to liabilities plus owner's equity, right? So what is account? Account is that records all of the changes in a particular asset's liability or stockholders' equity during a period. So it basically is a summary. For example, we talked about the categories of assets: current assets, fixed asset, and under current assets, we talked about cash, marketable securities, right? Short-term securities, short-term investments. These are all, the name of the short-term investment, marketable securities. So, and inventory, account receivable, right? So, what is cash and short-term investment? They are called account because they, record all the changes for a particular asset, right? So cash is a particular asset. So cash account is basically which record all the transaction or all the record related to what is going during the period, what is happening with this account, cash account. What are the changes in cash during the period, right? So the popular account names are cash, account receivable, not receivable. So we are once again defining the asset. Asset means economic resources that provide future benefits, right? Remember the word economic. So it means free resources. They are not part of assets like sunshine, these free services of your father because he's a lawyer, so he's giving you some kind of like free services. So these kind of things are not assets, okay? So let's define the cash. So cash include the money including bank account balances, paper currency, coins, certificates of deposits, and checks. For example, if check is coming to you, a customer deposited the check, that is also included in your cash. Okay, so if someone, okay, you paid the cash through online transaction, you have account with the bank, that is also cash, right? You have certificate of deposit, a short term, saving with the bank. Okay, we don't need this extra $10,000 for at least 3 months or 1 month. So why not we just keep that money wasted for in checking accounts? So why don't we just save it with 3 months and receive some interest? So these kind of stuff are also cash. So paper currency that you are in your business drawers, vaults, for petty cash, for petty expenses, like day-to-day expenses, like payment for water, payment for some some drinks, coffee, this kind of stuff. So you keep some paper money, that is also the cash. Coins, also cash. Account receivable. So what is the other name of this account receivable we talked about in our previous lecture? Customers. So account receivable means it is a promise for future collection of cash from the sale of goods, remember, or from services. So sale of goods. So it is specifically that account, so which you open it for your customers. And which kind of customers? Those who are cash customer or those who claim credits. So those customers who don't pay you in cash at the moment of sale, they promise that they will pay you in future. Okay, so if I am the customer and I buy this pen from you, and I give you the cash at the spot, so it means that is not account receivable because I pay you in cash, so cash is going to be increased, right? I receive the product is going to be decreased from your assets, and cash is going to be increased. So there is no account receivable. Accounts receivable occur when I say that, okay, I don't have money right now. I will be giving you money after 10 days. So you give me the pen. So what happened? Cash is not increased. Now you create account receivable. So remember, account receivable are your customers, and customers are your assets, right? Because they provide you future benefit and they have monetary value as well, right? Any question? If no question, then let's move to the notes receivable. So it's a tricky, but if you understand or if you have done your own business, so you pretty much understand this kind of stuff. So this is also one kind of account receivable, but the difference is that in note receivable, the difference is just interest and a note. So if I buy a pen from you and you are a seller, so I told you, okay, I would be paying you after 10 days. So you can just tell me that, okay, if I deposit my money with the bank for 10 days, I receive some interest. So if you want to have a cash sales, I'm happy to give you, but 10 days, if I'm allowing you the 10 days to pay me, so you need to give me the interest as well. So in that case, I signed a document on company pad or company letter promising that, okay, after 10 days, I would be paying you the price of the pen plus the amount of interest